Hey, everybody. Welcome back to another edition of Shoe and Show. We are glad that you're here. In today's episode, I'm bringing in my friend Gary Rains because, Gary, one of the things that we do, and our members know that we do, and by we, I mean you, this is management talk here, we track data for the industry in a variety of different ways. And we're always thinking about ways we can track even more data or data. We'll see what your preference is in a second on how you pronounce it. But one of the things we've been doing over the last couple of years, I believe, is trying to get our hands around inventory because our members are like, hey, can you tell us more about inventory? And we're like, yeah, we'd love to. Will you give us your inventory numbers? And the industry's like, no, we won't. So then you came up with this really good idea about how we can aggregate inventory numbers. And the most recent numbers are out. So I want to unpack that and also maybe pivot to some other economic issues or items that are out there on the horizon that we can help, inform our viewers and our listeners as to what's going on or what we expect to happen over the next few months at least. So with that, talk to me about the inventory numbers. Kind of first, what do you do? How do you gather them? And then let's break down the most recent report.
Sure. Happy to do that. You're spot on. This is something we have been a nut we've been trying to crack for a couple of years now to get at measures of the supply side in the industry beyond just looking at imports coming in or domestic production. So we began looking deeper at inventory numbers, and as you said, we kind of ran into a bit of resistance in getting inventory numbers from companies individually in order to aggregate them together like we do with our weekly sales surveys. But maybe a way around this is by looking at quarterly and annual reports, 10Ks and 10Qs from publicly traded companies involved in the footwear space. So we began doing that a couple years ago, and we're able to look at these individual reports, pull the inventory numbers reported by these companies, and aggregate them together, and then anonymously share them back with the industry, much like we do with the sales survey. And with that, we have begun doing this a couple quarters ago and producing it on the FDRA website. And we got our latest numbers for all publicly traded companies in the footwear space pulled together just here recently and posted that to the Intel Center here recently as well. Those most recent numbers show that in the latest quarter, inventories for the industry, at least the publicly traded slice of the industry, show that those footwear inventory numbers continued to grow in the aggregate, grow both quarter over quarter and year over year.
Yeah, so you kind of buried the lead on it. They're growing in the aggregate, but they're also at a 2-year high. And as we've all learned over the last few years, one, inventories are the largest expense our members have, right? That's the value of the inventory on the books is what is that anchor that weighs you down. You're trying to sell that through and then make room for new inventory. My mantra has always been that inventory is an art, not a science. We have watched over the last few years our members try to right-size inventory. In fact, my first education, the reason I took that mantra on was actually my first few years at FDRA. I signed on in February 2009, and right around the Great Recession. And if you look at the chart visually back then, you'll see that the anticipation coming out of the Great Recession from the industry is that the consumer is going to hit the ground running and like bounce back and buy more shoes, and it'll be great. We brought in a lot of inventory, and that did not happen. That Great Recession hung around a while, or at least the kind of the impacts of the recession itself. And so we were left with a lot of inventory. Fast forward a number of years to 2020, 2021, 2022. We all know what was happening at that moment. We were artificially spiking demand. We being the U.S. government with incentives and with stimulus. We were buying tons of shoes, and we were chasing inventory. But then the demand started to pull back to normal levels, historically normal levels, and that inventory was left there, and we were trying to sell through it. Then we have all these artificial, like man-made disasters impacting inventory decisions, and then we had the tariffs last year that front-loaded us, and we pushed inventory in. And so I guess the takeaway right now is we're at a 2-year high based on the numbers, the most recent numbers, and what does that tell you about what the industry maybe is expecting? Or is that 2-year high because of the front loading, the tariffs? Talk to me about the cadence of when the numbers come in and how we can assess some of the driving factors behind those numbers.
I had to chuckle a bit talking about the man-made disasters you mentioned a moment ago. It reminds me of a academic exercise back in grad school that we did, where we broke up into a
Where'd you go
number
to
of different.
grad school?
I did went to grad school twice.
And where? Where?
That would be at the North Carolina State University.
There you go. Go Wolfpack. All right, proceed.
That's right. Had to throw that in there where I can. But this academic exercise was done by a professor to where he had different teams of students break up into individual mini teams and look at this inventory exercise. And I'm going to get too deep in the weeds with it. But essentially, all the teams, the numbers just went to the moon. Everybody was either way too high in inventories or way too low in their inventories. And we didn't know what the other teams were doing. And at the end of the day, we compared those inventory numbers going imaginative quarters into the future, and the numbers were just all over the map. So it goes to your point about it's a bit more art than science. We certainly see that played out both in that grad school exercise many moons ago, but really even in the inventory numbers now, that not every company saw an increase in inventories quarter over quarter or year over year. Some actually saw declines. But for the industry as a whole, we did see those inventory numbers increase, something like 11% year over year in this latest quarter. To your question about, well, what does this really mean? And is this a reflection of the tariff loading going on earlier last year? I think yes, that's certainly something that's still playing out, and it really goes back to COVID. That I think we're still seeing those repercussions of COVID. That in the early days of COVID, of course, no one was shopping, no one was going out, inventories were bogging up at the port. Then we began to see, of course, the government throwing money at the consumer. Everyone was spending other people's money. Consumer spending was rebounded very quickly. We saw the inventory numbers decline rapidly, and we're seeing this back and forth reverberation that I think is still playing out now. It's a bit like when you toss a pebble into a pond, and you get those concentric waves that go out in circles, and I think that's really what we're seeing now is the long-term waves from that initial pebble going further out in time.
Yeah, and if you look at the chart visually, Gary, and I'm the layman, you're the economist. So I'm picking up things just visually as maybe like the common guy. I will say, and this can be found in the Intel Center for our members, the visual aspect of this. But from a growth percentage over the last few quarters, we're hanging out where we are relative to growth percentages in 2015, 2016, 2017, which were pre-COVID kind of normal years. I think the challenge is the blue line, the actual inventory levels are still super elevated. They are high relative to time. We were trimming inventories back in those days in some regard, even if there was, even if I guess the levels were much lower. I still, when you look at that line, feel like things are elevated, and just begs the question: if we're sitting on all this inventory, one, the consumer has been resilient. We'll say that. Purchasing power has been strong. We've starting to see a pullback somewhat. I think this will kind of parlay us into a broader conversation on prices in just a second. But visually, it's really an interesting chart because the numbers are still so elevated since 2021, 2022. And will we ever kind of bring that back down? And what are the negative things that have to happen economically for that number to go down, if that makes sense?
Yeah, good point. Talking about those inventory numbers over the last couple of quarters earlier in 2025, looking at very early consumer spending numbers and footwear import numbers, we had cautioned that those inventories were set to increase through the balance of 2025, and certainly that's played out to be the case. We've seen that while footwear spending has grown a bit last year, we've seen that footwear imports have grown much faster. Well, again, you got more supply than you get demand. Of course, that's a recipe for increasing inventories. That's exactly what's played out here. Those inventories increasing to the highest in the last 9 quarters or so, the highest last a little more than 2 years, as you had said. And I think it's something that continues to play out. I don't think the inventory numbers are going to get back to a pre-COVID level necessarily, but I don't think we're set to see them necessarily climb to the highs we've seen in the wake of COVID. So I think it's something that's set to play out for some time to come.
Well, and there's a lot of nuance to this, right? Because if you think about supply and demand just at its core, and you say, okay, Americans want to buy more shoes. We got to bring more shoes in. And so you should, in a simple kind of way, you should see increased inventories because demand is increased. You're trying to meet that demand. The problem is you have the tariffs, right? And you have the front loading. And so the companies think to themselves, look, prior to August, September, the tariff rate on these shoes is going to be X. If I get that product in now and work to sell through it, my margin, I'll be able to have better margins. Even if I keep prices flat, I'll be able to have better margins. So that shoe will actually be more profitable, even if I brought in before the tariffs, even if I sell it in 2026, if I have that capability. So a lot of this inventory, these spikes is in relation to that because the importer says, I may have to hold this inventory, but it's cheaper. It was cheaper for me to bring it in because the duties were lower. And so then I'll make more margin on this product. So there's a lot more nuance. It's not just supply to demand, one goes up, the other goes up, one goes down, the other goes down. There's so much more, particularly in a year where when the industry's tariffs essentially doubled. We'll have to look at what the final tariff number is, but we essentially doubled, or maybe even a little bit more than that. So that's it just shows you all the nuance that goes into how these numbers play out relative to inventory levels.
Yeah, absolutely. And it's not, I don't mean to imply that it's just a reverberation of COVID at all. That is a contributing factor. Certainly the Liberation Day this year, and of course the surge in tariffs on a range of goods, certainly footwear, has been another contributing factor this year. And it's all issues that have, I think, collectively helped to muddy the water this year, looking at anticipating sales, anticipating demand, and then by extension, anticipating how much imports a company needs to receive into the country. A lot of that, of course, had gone into bonded warehouses just to get it into the port before tariffs. Sat on those inventories for some time before they were really reflected in one's balance sheet. I think we're seeing that play out now. An additional issue we're looking at that maybe takes this inventory number a step further is getting into looking at aggregate margins across the industry, and that's a nut we have yet to completely crack just yet. That's a bit of a tease for something that we hope to produce in 2026, where we can take those inventory numbers, look at revenues by company, and of course aggregate them together and look at how margins compare from one company compared to the industry as a whole.
Yeah, for sure. I mean, it goes to even if you look at segmented parts of our industry, the fast fashion side of things has a lot more turnover, a lot more turn on their inventory annually than maybe a men's legacy leather shoe company, right? And so we've talked to members in both camps, and some are already selling that tariff product through because their inventory turns have been pretty frequent and they're moving product pretty quickly. If you're sitting on a legacy men's leather shoe company, knowing men buy shoes less frequently, it might take a full year for that company to sell through their inventory that came in before COVID. So even at the product specific level or the category specific level, decisions are totally different as it relates to bringing product in, avoiding tariffs or not avoiding tariffs, and how quickly you sell through that inventory. Now, prices are always top of mind when it comes to particularly the elevated tariff environment we're in, Gary. We track prices all the time. The most recent reading actually showed prices declining modestly, although that was driven by children's footwear exclusively, and the other categories, men's and women's, were up. I want to ask you about what your expectations for prices are in 2026, and then I want to break down some recent reporting from the Wall Street Journal about why collectively the economy has not seen these price surges in certain categories because of the tariffs. I think that's debatable, actually, but we'll tackle that next. Let's talk about pricing. What are your expectations for prices in 2026?
Sure. Yeah, talking about prices in the latest month, the government has reported retail prices for November. The latest month, we saw that footwear prices had declined 0.1% year over year. That reverses 3 straight months of year-over-year increases in prices. And as you said, that 0.1% was largely driven by a pretty sharp 3.4% drop in prices for kids' footwear. That's a 3.4% year-on-year decline. Excluding that, we'd seen women's prices that increased some, 2.2%. And I think that was enough, excluding children, to have driven total footwear prices higher year over year. But again, even with kids in the mix, it caused total prices to decline. As far as crystal ball for 2026, I think the tariff issue, as that plays out deeper into the year, I think we're set to see those retail footwear prices continue to increase. They have not increased nearly as much as what we were expecting maybe 9 or 10 months ago. We've seen continued increases until this November reading over the previous couple of months, but not nearly as sharp as what was expected. I think that's set to be the case deeper into 2026, that we're set to see this return to higher prices, retail prices for footwear, but the retail price increases will stay relatively modest. Some other issues playing into why that's set to be the case. Even with those tariffs pushing those retail prices higher, I think if we see that broader inflation stays relatively muted, then that's set to keep retail footwear prices fairly well contained deeper into 2026 as well. Some other issues we talked about: global prices across the global supply chain. It's not only a U.S. issue, but even worldwide, it's also staying relatively well contained. I think that's set to keep prices, retail footwear prices, contained deeper into 2026 as well.
Now, one article that caught my attention this week was one from the Wall Street Journal that was highlighting, or it was kind of a head scratcher in the sense that the journal, which represents kind of traditional economics, traditional Republican economics, I would say, kind of market-based approaches, global trade is good, tariffs are bad kind of perspective, outlining why in the most recent iteration of increased tariffs that we've seen, why we haven't seen this massive surge on prices that was declared by those of us around Liberation Day about what the impact would be. And it goes through a number of different reports, and we'll put the link to the article in the description below. But it comes down to, at least the authors of the report and the reporters themselves posit that essentially imports are dampened because consumer behavior is dampened. And so therefore, the impact on pricing is, one, there's things that happen throughout the supply chain, which we know. Factories take some on, those moving the product, the importers take some on, the consumer takes some on. So it's not a one-for-one, tariffs go up X, consumer pays X. While at the same time, consumer behavior is dampened and the economy does suffer because of tariffs. This doesn't say that the economy doesn't suffer, and that, interestingly enough, and ironically so, domestic production suffers, which, you and I knew this would happen, but it seemed like the Trump administration should be caught off guard that all this tariff action actually dampens domestic production. And so I know you've read it, what were your takeaways from that article? And is there nothing to see here with the tariffs? Is 2026 way different than 1930 economically and structurally within the U.S. economy?
I think certainly the economy is very different from where it was 90, 100 years ago. But one thing about the impact on inflation that the tariffs don't have a whole lot of direct impact on. The largest component of the basket of goods and services used to come up with the government's measure of the consumer price index is housing. And housing costs have declined year over year as we've seen mortgage interest rates decline. We've seen that pending home sales have rebounded and housing costs generally have fallen. Those lower rates have translated into lower house payments, and those lower house payments imply lower costs for rent. That if it doesn't cost as much to make a house payment, you're likely to see your rent payments decline as well. And that is the largest component of the basket of the consumer price index is housing. So not to get too deep in the weeds on the housing issue, but with housing costs coming down year over year, and we're seeing energy costs come down year over year. We've got oil prices the lowest in about 4 years, and that spills over to gas prices the lowest in almost the last 4 years. I think with energy and housing coming down, that's adding to that dampening effect on the broader measures for inflation. And by extension, that's keeping a lid on any dramatic increases in retail footwear prices. Yeah.
So the moral of the story is that the economy will suffer. There are a lot more levers that are pulled, but if you're a 99% import penetrated product like footwear is, and you pay, you typically pay $3 billion a year, give or take $100 million here and there in duties, and that number's, pushing 5 to 6. that's going to have a negative impact on your company or on your industry. But in a broader sense, it's a lot more nuanced, I think. And I think that's, we tell our members all the time, it's not all about footwear. I wish it was, but at times these policy decisions aren't all focused clearly on the impact on footwear and apparel production. So I think we're seeing that play out.
Yeah, we see this not only in business decisions, but in broader economics, that it's seldom yes, no, black and white, binary issue. There's myriad shades of gray, and there's always other factors that maybe weren't much of an impact before that have a bigger impact now, that again tend to muddy that water and take you from a black or white yes, no decision to some shade of gray. And we see that certainly playing out this year, that it's not just a COVID issue, it's not just a tariff issue, it's not just a housing issue or energy cost issue. There's all these other factors that add into the mix that keep me up at night.
That's right. Exactly. Well, Gary, we appreciate your insights as always. I know our members know this. To the broader industry, Gary is the life source of all of our trade data or data. Which do you prefer to close out our conversation, data or data?
Maybe I'm an old school data kind of guy.
Is that? And what was the guy's name on Star Trek: The Next Generation?
That would be data. Data. I don't know.
We've lost the young ones on that reference. So that's awesome. Well, Gary, thank you again. We appreciate it, folks. If you want to learn more, if you're not a member of FDRA and you want access to kind of ongoing data analysis or data analysis around the industry on a weekly basis, on an hourly basis, sometimes reach out to us. Hit us up at info@fdra.org. We'll send you membership information. Our membership ranks are growing exponentially because we're providing such great value. We've been around 82 years, and it's hard for me I haven't been here all 82, but it's hard for me to see another year or two where our value has been higher than this. So check us out. info@fdra.org is the email. Go to fdra.org is the website for more information. Make sure you subscribe to this podcast wherever you get your podcasts. We obviously do video now on YouTube at youtube.org. Hit up shoeandshow.com. I'm giving you all these websites to go check out. We have a lot of websites, which is what we like to do. Anyway, thanks for watching. We'll be back next week with another exciting edition of the Shoe In Show. Until next time, Shoe In Show is out.
Shoe In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.